What's good, everyone? This is Michael St. Clair with the Best of Society, and today we are going to do a market recap. So, going into the market spent all of last week doing the same thing over and over, rallying into resistance, getting sold, then bouncing, but each bounce was weaker than the last. And that's not noise, that's a tell. So, this week, let's talk about whether the dip is still worth buying or the real lines in the sands are, and if the AI trade is starting to look a bit frothy. First, let's talk about the mechanics of the market, because this explains the price action that we see today. The modern market is dominated by passive money, and what passive money means is ETFs, indices, mutual funds. And when investors pull out money broadly, those funds don't get to be selective. They have to sell their holdings to meet redemptions, and that usually includes the biggest names in the indices, the mega cap tech, blue chips. They tend to get sold the hardest. And not because anything has really changed in the fundamentals of the business, it's just because they're the biggest slice of the pie. So when you see strong companies getting dumped for absolutely no reason, that's the machinery. Indiscriminate selling, it's part of a system. Keep that in your head for the week. Now, are we in a bear market? Here's my honest read. I don't think that this is a full-blown bear market, not yet. I still think that dips can be bought on here on balance. And if we look at the intraday charts, 73.50, 74.03 have been working as buy levels. They are very key supports. And sometimes you take a bit more heat because we are in a more volatile environment, but it is the nature of the markets to go between volatile and very, very calm. I would say that the moves have been very, very choppy, and frankly, it's a bit random. And part of that randomness is stuff we don't simply have access to. What's being said behind closed doors, geopolitical decisions that we're not in the room for, and we can't trade on what we can't see. So instead, we lean on what the order flow actually shows us. Now let's talk about why levels evolve and why that matters. A quick concept that took me years to really understand is that these price levels are not permanent. At any given moment, someone is defending a price level and someone's attacking it. Maybe it's a desk protecting an option strike. Maybe it's a fund quietly building a huge position. Maybe it's a seller working out of some size. The moment that player finishes their job, the level breaks and they're just not there anymore. The market is, you gotta think of the market as alive. It's constantly evolving. There's new information that shows up every second. And if you're watching the actual orders, you could see that. I would say Friday gave us a perfect example. For example, we broke 74.03 in the Asian session, but barely traded below it once the US cash opened. Meanwhile, the rally died at 74.60 and we closed a week under 74.03, which we haven't done all week. So I like to read it like this. 74.60 is an important resistance zone, and now that, I mean, if we look at today, we've broken it, so it became a very key support. If we look below us at 73.50, there's not much short inventory sitting there. Otherwise, we would have seen a lot more trading down there and a lot more time spent on Friday. So my levels for this week, I have several levels. 73.50 is a very key support. That demand has to get neutralized before we even decide to go lower. And if you're bearish short term, you want us to see us take that out and stay below it. 75.40 was a key resistance, and it seems like we're grinding straight through it into the holiday weekend. So um, my previous thought was that we might see some fresh short selling going into that level, but if we look at the actual tape, there's not any active sellers. Maybe perhaps going into holiday weekend, it is 4th of July, it is quite unpatriotic to sell into America's birthday. So perhaps she'll see some sell pressure in the following week. But that is for the markets to tell us in real time. Now, if you look at longer term, I think 6,900 on the S&P is my bigger picture support. And if we actually trade here, I expect some serious interest from longer time frame buyers. And for reference, we are trading at 75.61 at the current moment. Now, I want to go to the AI trade real quick. Now, here's the part where everyone wants to argue about is AI stocks. You have one camp calling the top. You have another camp saying Micron runs to $2,000, and Micron's is about 11, $1,200 right now. And I take these both with a grain of salt because in my experience, trying to nail the exact top or bottom is a great way to lose money. So full disclosure, I flagged this name. I do think that it is a bit frothy. Now, I wouldn't necessarily short Micron just now, but I would be very hesitant to chase it up in the 1200s. But on a real dip, I do think that it has longer term momentum and it could continue higher for now. But here's what makes me feel wary. If you look at Palantir versus Tesla, very similar DNA in a lot of ways. Palantir has been cut in half from its highs, but Tesla has barely moved, propped up by millions of believers. Now, if we do get a genuine pullback in the indices, let's just say the S&P slides down to 7,000, which is about 8 to 10%. I do think that Tesla takes it on the chin and probably will double that move and the downside. So until that imbalance works itself out, I'm quite cautious because I think there's way too much leverage in the markets, and I do think there's too much degeneracy in the meme high multiple names, and not just here, but globally. So to be clear, I think AI as a technology is a real deal. There will be winners, there will be losers. It's just the name of the game. The question is whether the money stays in hardware or rotates into the applications sector. So that is the $1 million question, guys. Now, if you want to play it safe, here's where I would rather hide. I do think names like Intuitive Surgical around $400 and Rockwell around the high 400s in a real market sell-off, I do think that these carry lower beta and they will hold up way better. And that's where I could draw a clean 10 to 15% line and where I know I was wrong. And I can't say that about something else like Micron, where a 30% downside is totally on the table. On the value side, I would say Lululemon seems very interesting. It's down about 80% from the peak, sitting around 117. And yeah, it's still technically in a downtrend, but at some point you have to ask how much lower. Right now, it trades at a 10 PE in a market full of 200, 300, and no PE names. And if we do bleed under 100, you're talking about a 7 to 8 multiple on Lululemon, and that's deep value territory. So it might be worth looking to some leaps, some April to June 120 calls for next year. And if they were to decay to about $4 a contract, I do think the risk reward gets very interesting. But yeah, guys, to sum it up, it's not a bear market necessarily in my book, but a market that's getting choppier and more crowded in the most obvious trades, and that is a urge for caution. So I would respect the levels 73.50, 74.60, 75.40, and 6,900 as the bigger backstop. And I will be very careful out there with leverage. None of this is financial advice, of course. It's just entertainment value. It's just how I'm thinking about the tape. Trade your own risk. Trade your own plan, manage your own risk, and remember, any position could go against you. So plan accordingly. And if this helped, please drop your comments in the section below. Be sure to like, subscribe, and follow for the next video. This is Michael St. Clair signing out. I will see you in the next one.